Performance in the fourth quarter of 2019 was subdued, largely as a result of rand strength and rising inflation-linked bond yields. However, the portfolio added 70 basis points of alpha versus the strategic benchmark. 12-month performance was more robust with an 8.3% return versus the peer average of 8.1, STEFI benchmark 7.3, strategic benchmark 5.8, and inflation 3.6. Inflation remains subdued against a backdrop of low global inflation, lower oil prices, weak domestic demand, and a stable local currency. The latest CPI number of 3.6% was largely driven by a 6.5% drop in fuel prices, and housing, which makes up 24% of the basket, only up 3.1%. Inflation is expected to pick up and peak just below 5%, increasing as a result of base effects on oil and food pricing. Further increases to inflation could unfold due to tensions in the Middle East affecting oil prices, adverse weather conditions affecting food prices, pass-through effects on a weaker currency, and higher prices from government services. The door for monetary easing has been opened as a result of inflation expectations being anchored at lower levels, coupled with extremely poor growth. Growth unfortunately remains under pressure as a result of electricity supply constraints, an overburdened consumer, and a poor political climate, which is business unfriendly. With government slowly moving in the right direction, growth is expected to recover to above 1% by year end. Looking at the drivers of return, inflation remains low but beginning to rise, which is supportive of inflation-linked bonds. Interest rates are dropping, supporting fixed bonds, and in general, fixed income assets are trading on high real yields. If we assume an inflation of 5%, money market is yielding 1.6% real, 5-year fixed bonds yielding 2% real, and 5-year inflation-linked bonds yielding 3.6% real. There are a number of risks, though, which could translate into rand weakness and or higher bond yields. These include a deteriorating budget deficit beyond 6.5%, unstable debt to GDP ratio rising above 72%, impending credit rating downgrades, specifically Moody's, which to a large degree is priced in, rising credit spreads, and any globally driven risk-off events. Looking at the positioning of the North Star Income Fund and taking the risks into account, versus the strategic benchmark, the portfolio is neutral duration on fixed and inflation-linked bonds, elevated levels of foreign cash and bond holdings versus history, although still slightly underweight, and underweight property. As a result, the North Star Income Fund remains well diversified, trades on an attractive 3.6% real yield, and has the potential for additional returns in the event of assets repricing closer to fair value.